Hey everyone, welcome back to the channel. I'm Whitney Michael, and today we're diving into a topic that can be a little confusing for homeowners and even home buyers alike. If you've heard of terms like HELOC, HELOAN, and cash out refinance tossed around, but you're not sure how each one works, stick around. We're going to break these down so you can decide which is best for you. Before we jump into the details of each option, let's quickly talk about one important thing you'll need for all of these: home equity. Home equity is the portion of your home's value that you actually own. You can calculate it by subtracting what you owe on your mortgage from what your home is worth. So for example, if your home's value is $300,000 and you owe $150,000 on your mortgage, you have $150,000 in equity. Now that we've got that covered, let's look at the three options that could help you unlock that equity: the HELOC, the HELOAN, and the cash out refinance. Each one has its own advantages, and understanding them can help you make the best decision based on your needs. Let's start with the first one, the HELOC. What is a HELOC? It stands for Home Equity Line of Credit. Now, a HELOC is basically a revolving line of credit that allows you to borrow against your home equity. Think of it like a giant credit card that's secured by your house. You're given a credit limit based on your equity, and you can borrow from that limit, pay it down, and then borrow it again. One of the key benefits of a HELOC is flexibility. Let's say you get approved for a $50,000 line of credit. You don't have to take all of it at once. You can borrow what you need when you need it, whether that's for a home renovation, a down payment for an investment property, covering unexpected medical bills, or paying off high interest debt. And you can keep borrowing as long as you stay within your limit, just like a credit card. During the draw period, which typically lasts 5 to 10 years, you may only have to make interest payments on what you've borrowed. This is great if you want lower monthly payments in the early years. However, keep in mind that HELOCs usually have variable interest rates. The variable rate means your payments can change over time. So while the initial rate may seem lower than a fixed rate loan, it's important to plan for potential increases. Some people find this flexibility helpful, especially if their plans for using the funds aren't fixed. But the risk of higher payments down the line could be a deal breaker for others. Please be careful of those variable interest rates. Another thing to consider is that a HELOC can be a little more difficult to qualify for. Lenders will typically look at your credit score, income, and how much equity you have in your home to decide how much you're eligible to borrow. And since your home is on the line, if you can't keep up with the payments, you could risk losing your home. Let me say that again. Your home is on the line. If you cannot keep up with the payments, you could risk losing your home. Next, we'll talk about the HELOAN. What is a HELOAN? It's a home equity loan. Now let's talk about this. This is different from a HELOC in that it's a lump sum loan. With the HELOAN, you borrow a fixed amount of money against your home's equity and then make regular monthly payments to pay it off over a set period. Think of a HELOAN like a traditional second mortgage. Unlike a HELOC where you can borrow and repay repeatedly, a HELOAN gives you a one-time lump sum. You'll also typically get a fixed interest rate, which gives you a peace of mind because you know exactly how much you'll pay each month for the life of the loan. The fixed nature of the payments can make it easier to budget, and you don't have to worry about fluctuating interest rates like you would with the HELOC. However, keep in mind that you're borrowing a lump sum up front. If you don't use all of the money, you may end up still paying the interest on the entire loan amount. HELOANs are great for large one-time expenses, or if you prefer the certainty of fixed payments, but just like a HELOC, there are risks. If you can't make the payments, you could be putting your home at risk. So be sure you're confident in your ability to repay the loan. Now, let's look at cash out refinance. This is where you refinance your entire mortgage for more than you currently owe and take the difference in cash. Let me break that down. Let's say your home is worth $300,000 and you owe $150,000 on your mortgage. If you wanted to access $50,000 in cash, you could refinance your mortgage for $200,000 and then use that $50,000 however you choose. The benefit of a cash out refinance is that it allows you to tap into a larger portion of your home's equity than a HELOC or a HELOAN might. Since you're refinancing your mortgage, you may be able to take advantage of low interest rates, especially if your current rate is higher than what's being offered. Now, that may not be true in today's market. We all know how interest rates are as of right now. Another perk is that you're replacing your current mortgage with a new one and potentially a better interest rate. Potentially is the key word there. But remember, you're also resetting your mortgage term, which could mean you're paying off your home for a longer period than you originally planned. While this could lower your monthly payments, you may end up paying more in interest over the life of the loan. Cash out refinances are great if you need a large sum of money and want to lock in a good rate, but they aren't the best option for everyone. If your current mortgage rate is already low, refinancing could end up costing you more money in the long run, especially if you extend your mortgage term. It's something to really think through. As a homeowner, once you've built up equity in your home, you have some powerful options at your disposal. The first step is to ask yourself what your financial goals are. If you're planning to stay in your home long term, you might want to use that equity to make home improvements that will increase your property's value, like a kitchen remodel or adding an extra living space. Not only does this increase your home's value, but it can also enhance your living experience. On the other hand, if you're looking to access funds for other purposes like paying down high interest debt, investing, or funding a major life event, tapping into that equity can provide you with much needed liquidity. Just be mindful of how you use it. While it's tempting to borrow against your equity, make sure that you're using it in a way that aligns with your long-term financial goals. Whether it's improving your current home, buying a new one, or investing for the future, the key is to have a plan for that equity and ensure that it's being put to work in a way that benefits you in the years to come. Now, what should a home seller do with their home equity? If you're considering selling your home and you're curious about what to do with your equity after the sale, there are a few important things to keep in mind. First, you'll want to think about your next steps, whether it's buying another home, renting, or perhaps even using the proceeds to fund a new venture or investment. When you sell your home, the equity you've built up is essentially cash in your pocket, and how you use it will depend on your goals. If you plan to buy a new home, your equity can serve as the down payment for that next place. For many people, the equity they've accumulated is what allows them to upgrade to a larger home, buy a property in a different area, or even pay off debts that were accumulating over time. For example, let's say you sell your home for $400,000, and after paying off your mortgage, you have $100,000 in equity. You could use that equity to make a down payment on your next home. This can help you lower your monthly mortgage payments, especially if you've sold a property with a high mortgage balance, and could even allow you to buy a property that's less expensive, freeing up cash for other uses. Another great option is to use your home equity for an investment property. Many sellers use the funds to purchase rental properties, which can create passive income over time. If you've built up enough equity, this could be a great opportunity to set yourself up for future wealth. But it's not just about real estate. You might choose to put your equity into other investments such as stocks, bonds, or a retirement account. Many people choose this route if they don't want to deal with the hassle of moving again or being a landlord. Diversifying your investments outside of real estate can be an excellent way to secure your financial future. If you don't plan on purchasing a new home right away, consider saving some of your equity for a rainy day fund or to fund your next business venture. The last thing you want to do is rush into something just because you have the money sitting in your bank account. Take time to think through your options and talk to a financial advisor about how best to use the proceeds from your sale. One strategy to consider if you're downsizing, is to use equity to buy a smaller home with a lower mortgage, or even pay off your mortgage entirely. That way you have more freedom financially and fewer monthly bills to worry about. Debt-free living. Alternatively, some people may decide to sell their home, take a break from buying, and simply rent for a while. Renting could give you the flexibility to explore different areas or wait for the perfect time to purchase a new property, especially in a fluctuating market. Before you make any decisions, I always recommend speaking with a financial advisor or a trusted real estate professional who can help guide you through this process. They'll help you understand the tax implications of selling your home, as well as the best ways to use your equity to secure your future. So which option is right for you? The right option depends on what you need. If you're looking for flexibility and only want to borrow what you need, a HELOC might be the best fit. If you need a lump sum with predictable payments, consider a HELOAN. And if you want to access a larger portion of your home's equity and possibly lock in a better interest rate, a cash out refinance could work for you. And if you're a home seller, don't forget to consider how you plan to use your equity after the sale. Whether it's investing in your next home or finding a way to use those funds to achieve other goals, your equity can be a powerful tool. Each option has its pros and cons, and what works for one person may not be the right choice for another. Before making a decision, I always recommend speaking with a mortgage advisor or financial planner who can help you understand the long-term impact of each option and how it fits into your overall financial goals. I hope this video helped clarify the differences between a HELOC, a HELOAN, and a cash out refinance, and gave you some ideas on what to do with your home equity. If you found it helpful, don't forget to hit that like button and subscribe to the channel. Also, leave me a comment below if you have any questions or if there's a topic you'd like for me to cover in a future video. As always, thank you so much for watching. I'll catch you in the next video. Peace.